September 15, 2008. New York wakes up to silence. Inside glass towers in Manhattan, phones ring but nobody answers. Traders stare at screens glowing red. Lehman Brothers has filed for bankruptcy. The 158-year-old financial giant is gone overnight. But here is the uncomfortable question. Was this truly sudden, or did the people at the top see it coming and stay quiet? Months before the crash, warning signs were flashing. Analysts questioned the numbers. Economists raised alarms. Insiders whispered that the housing market was unstable. And yet, the machine kept running. Because the profits were enormous, and as long as money was flowing, nobody wanted to stop the music. To understand how it happened, we rewind to the early 2000s. America was booming. Housing prices were rising fast. A powerful belief took hold. Real estate never goes down. Banks began approving mortgages for almost anyone. No stable income? Approved. Poor credit? Approved. These were called subprime loans, high-risk mortgages given to borrowers with weak financial profiles. At first, rising home prices hid the danger. If borrowers could not pay, they refinanced or sold higher. It felt safe. It felt unstoppable. But beneath the surface, the foundation was fragile. Banks bundled thousands of mortgages into mortgage-backed securities and sold them worldwide. Pension funds bought them, universities bought them, governments bought them. Many were stamped with the highest safety ratings. Then came collateralized debt obligations. Imagine building a tower from unstable blocks, then selling pieces of that tower as premium investments. Each layer promised returns. Each layer buried more risk. Inside Wall Street firms, some knew the structure was unstable. Internal messages described certain products as garbage, but bonuses were tied to short-term profits. Growth was rewarded. Caution was not. The system looked strong, but it depended on one dangerous assumption, that housing prices would never fall nationwide. And that assumption was about to be tested.
In 2006, housing prices peaked. By 2007, cracks began to show. Adjustable rate mortgages reset. Monthly payments doubled. Defaults increased. Foreclosures spread. Mortgage-backed securities lost value. Banks realized they were holding assets no one could price. Fear spread. Banks stopped trusting each other. Lending froze. Credit began to dry up. In March 2008, Bear Stearns collapsed. The crisis was no longer theoretical. It was real. Then, in September, Lehman Brothers filed for bankruptcy. Markets panicked. The Dow Jones plunged. Institutions across the world trembled. The financial system stood on the edge. More than 8 million Americans lost their jobs. Millions lost their homes. Retirement accounts shrank. Global trade slowed. Entire industries contracted. Governments intervened. Congress approved the Troubled Asset Relief Program. Hundreds of billions were injected into banks. To many citizens, it felt deeply unfair. The phrase, "too big to fail," became part of everyday language. Trust was shaken. Regulations were introduced. Markets eventually recovered, but global debt surpassed pre-crisis levels. Risk did not disappear, it evolved. The lesson was not simply greed, it was incentives. When profits are private but losses are socialized, risk expands. When short-term gains are rewarded and long-term stability ignored, warning signs are dismissed. If another bubble is forming today, would we recognize it? Or are we once again convinced that this time is different? Because before every major crash, there is a moment when the danger is visible, but ignored. And when the music is still playing, very few choose to stop dancing.